Welcome to our latest webinar for corporates. In this series, we'll be examining recent events and looking ahead at what might be in store for financial markets and the economy. And welcome everybody to today's presentation. Hopefully over recent months, you'll have seen the improvements in economic activity, but certainly over the last few weeks, been a few hiccups, as is mentioned in the title. So we're going to move very swiftly through the macroeconomic forecast, which looks back at the previous quarter and ahead to the end of the year and into 2022. But let's move swiftly on to the content slide, and this will show that we're going to look at macroeconomics first and the global recovery, and then we're going to look at some of the challenges to that. So from the labour markets, from inflation, and also from changing interest rate environment. Before, of course, we look at the FX markets, and then we'll move on to my disclaimer, followed by Piers' presentation. But let's look at the macroeconomic picture and the forecasts on this next slide. From the International Monetary Fund's World Economic Outlook of July, they all look robust. Growth in the US expected to be 7% for this year. Growth in the UK expected to be 7% for this year, and growth in India expected to be close to 10%. So some very robust rebounds. But I think the most surprising rebound of all of them is the US's. If you think of the damage that coronavirus and COVID has done to the US economy, then it is a very strong rebound, and one that's already seen the US recoup all of its lost economic output. So anything from here is growth from where we were pre-pandemic. We're also expecting very strong growth in 2022 as well, and growth of almost 5% in the US looks favourable to growth that we're expecting to see in Euroland and the UK, although I would have to say that growth for the UK in particular is going to face some risks, some challenges. The same for Euroland, because supply chain disruption has definitely been in evidence over the past few weeks. Now, if we look at the next slide, that has manifested itself in some further reduction in activity rates as far as the manufacturing PMIs. I would state that as far as services numbers are concerned, there was actually a modest improvement from the UK. So we've seen a pickup in activity from August through to September in the UK, but for virtually every other economy that we see here, for the US and Euroland in particular, we are seeing a slowdown in activity rates as far as services growth is concerned. For manufacturing as well, certainly what we've seen as far as the rationale for the slowdown is concerned, the vast majority of the manufacturing sector is saying this is down to supply chain disruption, the inability to get raw materials or semi-manufactured materials in order to complete the manufacturing process. So there are some question marks about whether this global recovery will meet or even beat those forecasts that we saw from the International Monetary Fund. And those questions have certainly been elevated in volume over the course of the last couple of weeks. Moving on to the next slide, one of the things that has undoubtedly been a factor, and it's one that I've drawn upon on many an occasion, has been the fact that supply of labour looks as if it is reduced versus where it was on a pre-pandemic level. But it's not coming back as fast as many would have expected. Now, we are seeing the withdrawal of a lot of those labour support mechanisms that we saw introduced. So things like in the UK, for example, the furlough scheme. But you can see that the rates of labour force participation, which prior to the pandemic were running at around 69, 70%. Well, those rates of labour force participation are now lower than that. And actually, they've been on a downward trend in the US over the course of many years. Same thing is true in terms of the UK's rate of employment, which has dropped back from around about 62% to around about 60.5%. And this shows that the underlying labour supply has been on a downward track since the pandemic, but hasn't been recovering. Now, will the ending of the furlough scheme in the UK lead to a sudden increase in participation and in employment rates? Possibly and potentially. But I think that we're in for some restrictions in terms of labour supply across a number of sectors. So things like we've seen in logistics, for example, problems there. In the construction sector, we've seen issues there. Even in retail and retail services, hospitality, for example, we are seeing reductions in labour supply there as well. So that could lead to some significant wage inflation in those economies. We're also seeing similar problems with regard to labour markets across Euroland as well. So expect this to force up the price and the cost of labour, but don't expect that to see a material improvement in underlying labour supply. So I think demand will continue to outstrip supply throughout the remainder of 2021 and 2022 at a bare minimum. Moving on to the next slide. What are we seeing with regard to some of the other areas of supply chain disruption? Well, we've seen a huge increase in terms of energy prices recently, both because of the increase in oil prices, but more materially because of the real surge in gas prices per therm or per kilowatt hour, depending on how it's measured. It's more measured per therm than it is per kilowatt hour in the UK. In Euroland, it's the reverse. So those energy price increases are certainly posing some short-term risks to inflation. One would expect that once we get through the periods of heavy usage, then the prices will fall back, but they probably won't fall back to the levels that we saw them rising from. And a lot of that is down to a lack of gas storage. Some of that is also down to political factors. So the fact that Russia is in dispute with the rest of the Western world over the building of a second pipeline, which circumvents Ukraine. I think that has caused some problems and has led to restrictions in terms of Russia's gas supply into Europe. Moreover, there are other political problems that could cause some further increases in UK electricity prices, such as the fishing dispute with the French, and also that's been exacerbated by a fire that we saw at the big interconnector that's based in Kent. So there is going to be some risks, some upside risks to electricity prices. But added into that, we've seen higher prices across a broad range of building and construction materials. And that is likely to be at least a short-term risk, but possibly a medium-term risk, because it's about replenishing stockpiles as they get exhausted. So those inflation risks, I think, have then led to some recalculations as far as where interest rates are heading. And if we look to the next slide, then this it looks fairly dull, but this could get a lot more interesting over the remainder of this year and into 2022. I mean, there's big suggestions as far as the UK is concerned, as far as the market pricing is suggesting, at least, that we could see 3 rate increases between now and the end of 2022, according to the United Kingdom. I mean, I can't support that, and I think that would be ludicrous, but that's what the market is anticipating, and that's altered how forward pricing is being priced for as far as sterling against the dollar and the euro are concerned. It's much more sanguine as far as Euroland is concerned, but there are question marks about whether there's still the need for the monetary loosening that is set to continue into 2022. And as far as the US is concerned, we're getting more and more clamour from members of the Federal Reserve to end the asset purchase program and start that process of tapering as soon as possible. So probably November, we'll see the asset purchase tapering begin, and that'll be completed most likely by summer of 2022. So that would open the door for rate increases from the US in late 2022 or very early 2023. At the moment, the markets are split between whether it will be a 2022 or 2023 rate increase. But that's a material change from where we were, where a couple of months ago, we were really talking about the only possibility of a rate increase coming in 2023 for all of those major central banks. And now it looks as if it's only the European Central Bank that will probably stick to 2023 before they start tightening monetary policy. So what does all this mean for the currency markets? Well, if we look at this final slide before the disclaimer, this will show that our forecasts haven't changed that much at the moment, but they are likely to be changed. I think that really we're talking about the position for sterling being weaker than it was. And I think that sterling dollar now is in a lower trading range than it was during the summer, with the risks being that against these forecasts that you see, we're actually going to struggle to break back above 139, and the trading range being around about 131.5 to 139 over the next few quarters. Sterling euro as well. Well, yes, we're testing up into the high 117s again, but I think it's unrealistic to expect that the pound will make much further headway from there. So 118 provides a cap, and then the downside is probably 111, 112. With the potential for the risks of the move coming quicker if indeed those problems around supply start to impact on the UK's economic recovery. And there are other factors here as well that we need to consider, that being that if there is a significant resurgence in COVID infections over the course of the winter months, then the risks are that this will lead to some localized or nationwide lockdowns, which would have a much more negative and detrimental effect on the UK's economic recovery than if they were in those lockdowns and restrictions were introduced in Euroland or in the US. So I think there are some asymmetric downside risks. And then finally, we are seeing some challenge as far as emerging markets are concerned, particularly with regard to Asia, where there has been a resurgence in coronavirus. So some pressure on those currencies to the downside, particularly against the US dollar. What we have seen, therefore, is a re-emergence of dollar strength. We've seen the dollar becoming a safe haven once again. But remember, it's not all plain sailing for the US either. There are some significant issues for them to address, not the least of which is the threat of default if the Democrats and Republicans can't resolve the current debt ceiling standoff that we're seeing in the Senate at the moment. So I'll leave it there and I'll hand over to Piers, just leaving you very quickly with my disclaimer, and I look forward to your questions at the end of these presentations. Thanks very much, and over to you, Piers.
Called this month's webinar Blue Turns to Grey, a time to be nimble and alert. And the reason for that is I think there's quite a few risks. And I think we've had a few years where there's not been these risks, but I think they're coming now. So if we go to the next slide, you'll see the S&P index quarterly chart. And the reason I have this chart on here is because if you look, there's a spike at the top. And that spike normally indicates that we could be coming to the end of a trend. Now, this is a rally that started at the financial crisis, and I've just taken the S&P as a bull-weather US equity market. But this is suggesting to me maybe the market is going to start to turn round. Maybe it's overdone. That's a very negative quarter. The price closed near the low after trying higher in an uptrend. But what is even more negative is if we look at the next slide. So if we go to the next slide, that is the S&P index monthly chart. Now, this has also a very negative month on it. So last month, you had a higher high, lower low, lower close. That, after an uptrend, is called a bearish outside session. That makes me very negative on the S&P at the moment. We closed at the bottom of the month. The uptrend broke. Now, why is this all important? Why, when you come to an FX webinar, are we talking about equities? I think it's all to do with the whole situation in the US. What happens is if the stock markets go down, then you tend to find the dollar strengthens. So as Neil was talking, bond tapering sort of maybe finishing, it's the reason people might go into the dollar. Now this, while we're below 4465 on a monthly close, I would look for continued moves lower in the S&P and consequently the other American markets. Above 44.65, then maybe the dollar's going to lose a bit of that attraction. But at the moment, below there, I'd be positive for the dollar and negative for equity markets. So we look at the next slide. This is the dollar index quarterly chart we put on last time. And on this chart, I showed you that we had a down move from 2001 to 2008. The dollar moved lower. Then from 2005, 2009, it started to rally. And when it rallied, we can see the top was 61.8% both times. Then it fell back down, and each time it's bounced off the 38.2%. And that's the key here. We are still trading between the 38.2 and 61.8%. So to get that longer term directional view, you need to break out those two. But they're both a little way away. So let's look at the next slide, because on the next slide, I zoom into a bit closer, the dollar index weekly chart. So here we can see we had the move down through 2020, 2021. Where did the dollar index stop last week? Last week, we saw it get up to the 38.2% and it stalled and it started to come back off. So it's just a knee-jerk reaction. We also have the rule of polarity. It was the old support, this area here, and that is also acting as resistance. So to get the next bout of dollar strength, you need to see a weekly close above that 94.65 area. A weekly close above there, then I think we could see a move up towards 97 start to play out. So it's very important to see how far does this pull back off the 38.2% go. So on the next slide, we're going to start looking at the actual currencies themselves. And here is euro dollar. This is the quarterly chart I had on the last webinar I did. And I was pointing out that we were falling off that 38.2% area again. So it was putting the pressure on probably for a move lower. And if we look at the next slide on there, this is the quarterly chart now updated. And I've zoomed into that last bit. So we're within those retracements that we saw on the other chart. But looking here, you can see we've closed below that 117.70 quite clearly. So I think that changes things for euro dollar. I think now the risk is a move down towards 112.40, 113.60. And that sort of stays my view while rallies are held by the 117 area, 117, 118. So I'm a bit more negative than Neil's forecasts on euro dollar. I sort of think there's a risk we go down lower. If we were to get above 118, then I would have to start to rethink it. So any monthly close above 118, 119, I'd have to start to think, why is the market getting back up here? But we can watch that as the months go by. But at the moment, I think the risk is maybe a move lower towards 113, 112, while that 118 area holds as resistance. So moving to the next slide down, we'll look now at the sterling index. Now, why do I look at the sterling index as opposed to just sterling dollar, sterling yen, or euro sterling? It's the easiest way to find out if sterling is in or out of favor internationally with the main investors. And I use this just because it's worked so well. Ever since I've been in the FX markets, this has never so far let me down. This is where it must all go wrong. I should never sort of say things like that. But last time we were looking at two retracements on the same chart. So this was the high to the lowest close body, and you had the 38.2% at 66, and you can see that it fell off there in 2019 and hasn't got through it again. But more interestingly, on the next slide down, this is the sterling index taking the highest high to the lowest low on a good move. I ignore that spike because it was the flash crash and no one's quite sure where the bottom is. But this has worked perfectly. So this has worked perfectly for so long on sterling, working out whether you want to be short sterling or long sterling. It has the 38.2 coming in at 64.916. And there's been 9 or 10 occasions where the quarter has gone up to it and then backed off it. And we've seen it cap really the market for the last 3 quarters. And so maybe it wants a bit of an ease back lower. But the good thing is there's no crash off it at this stage. So if we can get back above that 60, well, it's basically 65, then things aren't so risky for sterling. So we know exactly where it needs to get above for sterling to strengthen across the board. That is above 65, 66. That is the buffer zone. If it gets above there, then sterling is going to do a large strengthening, I feel, up towards 69. But at the moment, you have to respect that you're below it. It might ease off a bit. Where does the pullback lower start to become into more than a pullback lower, and maybe it is sterling starting to collapse again? Really, it has to get back down below that 62 area, the 23.6. While it can hold those, the attack higher is in place. So what does that mean for the currencies themselves? Let's have a look on the next slide at sterling dollar quarterly. Now, how did that sterling index chart help us? It helped us because it fell off last quarter. Why did it fall off? Well, look at here, sterling dollar. We had the rule of polarity. That is those black circles across. The old support becomes resistance. So the lowest quarterly close we had in the collapse down of cable in the financial crisis was 143.25. Every time since it broke below there in 2015-16, every time it's rallied back up, that 43.25 has capped cable's rally. So it makes it nice and simple. Where do you turn positive that sterling dollar is going higher towards 154 on a quarterly close above 43.25? What do you do until then? You sell 143.25, you make money. So that's how the market's playing it. Now, last webinar, I said, look for a move down towards 134, 135 was the risk. And that's exactly where the market's gone down to. And it's bouncing initially off that 134, 135 area. What you need to see, where does it start to give signals that it might be wanting to go back above that 43.25? Well, if we look at the next slide down, we can look at this chart here. It's quite helpful. This is looking at the last move down of sterling dollar, the 2015-16 collapse. Now, again, look, the 143.25 level is critical, but look at the retracement here. It's the 38.2 comes in at 139.75. So while rallies are capped by 139.75, 141, there's a risk that sterling dollar might have a look down towards the 131 area, 131, 132, maybe at a push down to 129. But that's where there should be good support if we do get that test lower. Looking on to the next slide now, we can look at euro sterling. Now, euro sterling, this is exactly the same chart that we had last time. Now, the circles seem to have got pushed over here slightly, but basically, we'll get that correct for when we send it out. What we're looking at here is the break of that trend line. We broke the trend line, and that was 1, 2, 3 candles ago. And then you retested towards the trend line, and now price is coming off. But what is holding price at the moment is that 38.2% at 84. So at the moment, I think that when we look at euro sterling, we have to think about those two levels, the trend line and the support. So resistance on rallies should be in the sort of 87.5, 88.5 area. And that should cap rallies at this stage. The real change comes is if you break that 84 area. If euro sterling starts to break the 84 area with continued strength, then it's probably opening up potentially 81 and 78, the 50% and the 61.8%. So I will keep you posted on those as the quarter progresses. What's it looking like? We need to look at the monthly charts, and next month we will focus on monthly charts as opposed to these longer term quarterly charts. And the final chart I thought I'd finish with on the next slide is Brent oil. Now, last time I finished on this slide and I was saying there was a risk that we were going to break that trend line. And we have broken that trend line. And I had targets of 81.74 being the 50%, followed by 97.25. Well, we've hit the first one at the 81.74. And longer term, while that trend line price holds above that trend line on any pullbacks, the risk is we could go towards that 97.25. Personally, I have strong views that this could be the start of a very strong move in oil higher. But for the moment, I just look for 81.74 and that 97.25, or we've got the 81.74. On the daily chart, though, oil does look negative at the moment. So I think you might see a bit of a move lower in the short term, but watch how far that goes, because markets tend to zigzag rather than go in a straight line. There should be good support at the 66 area. And while you're above 66, the risk continues for moves higher. Now, I appreciate we try and cover a lot of ground in this webinar. And although there is some time for questions afterwards, if you do have any questions on my charts and presentations, please contact your salesperson and they can get in contact with me on your behalf. Thank you very much for your time.
Thanks very much for listening to the webinar. We hope you found it informative. The next in the series will be available shortly.